Ever feel like the financial world is speaking a completely different language? Whether you're thinking about your own future or, just trying to understand the news, figuring out how money actually moves and grows,
Well,
but it's fundamental.
it really is. It's the engine under the hood of the whole economy.
And that's exactly what we're digging into today in this deep dive. Chapter 2, it's kind of the bedrock, isn't it?
Absolutely.
We're going to unpack investment capital, look at these interesting tools called financial instruments that let it flow,
Right.
and then explore the different marketplaces, the financial markets, where all the action actually happens.
Yeah, and
Yep.
the goal here really is to give you a solid grip on this stuff. The important bits without making your head spin with jargon.
Exactly. We've got some detailed notes here covering these core ideas pretty thoroughly.
That's right. So if you've ever wondered, say, how does a small business actually get the money to become a big one? Or even what happens with my savings after I put them in the bank? Well, you're definitely in the right spot. We're going to tackle those kinds of questions and hopefully connect the dots for you.
Okay, great. So let's jump right in. Investment capital. It sounds, well, a bit formal, maybe a bit Wall Street. What is it really?
At its heart, it's simply wealth. Accumulated resources. Now, that can be tangible things like, machines in a factory or buildings,
Real stuff.
real stuff.
Hmm?
Or it can be representational, like the money sitting in your bank account or shares you own in a company. But the real power, the magic, happens when that wealth isn't just sitting there.
Oh.
It comes alive when it's put to use productively
Hmm.
through investment. That's the key.
So taking that wealth and actually doing something with it, why is that so important for the economy as a whole?
Well, think about it. A good, steady flow of investment capital is basically the lifeblood of a healthy economy. For businesses, it's crucial.
How so?
Capital lets them expand, maybe buy better equipment to become more efficient, drive innovation. Remember that software company example? Investment capital is what lets them hire those developers,
Right.
right? To build that next big app. They need that money before the app starts making any income. It covers salaries, research.
Yeah, that upfront cash injection to get things going.
Precisely. And if you zoom out to the bigger picture, if there's not enough investment happening, whole industries can just stagnate. And that, unfortunately, leads to job losses, maybe a lower standard of living for everyone. So it helps individual companies, sure, but it ripples out across the whole economy.
That makes total sense. Okay, so if it's that vital, where does it actually come from? Who are the suppliers of this capital?
Fundamentally, the source is savings. That's what our notes really stress.
Yeah.
Anytime someone, an individual, a company, even a government, has income left over after their spending, that surplus is potential capital.
Leftover money.
Exactly. And it comes from a few different places.
Yeah.
Individuals, like you and me, are a big source. When you decide not to spend money today, but save it instead, maybe in a savings account, or buying a government bond, you're essentially supplying capital. And usually you get some kind of reward for that, like interest, for delaying your spending.
So even just putting money in my TFSA counts as supplying capital.
Absolutely. You're providing funds that can then be used by businesses looking to grow or governments needing to pay for things.
Okay. Who else?
Well, non-financial companies like manufacturers or retailers, they also contribute. Often, though, they reinvest their profits directly back into their own business.
Makes sense. Keep the money in-house.
Right. Governments can be suppliers, too, if they manage to run a budget surplus, taking in more tax money than they spend. It's not super common, but it happens.
A surplus, yeah, you don't hear that every day.
No, but
Yeah.
it's part of the picture. And very importantly, for a country like Canada, foreign investors are a huge source.
Ah, international money.
Yeah. Canada is seen as relatively stable, politically and economically, and there are good opportunities here. So investors from other countries often buy shares in Canadian companies or invest in our real estate, things like that. That inflow is really vital for us.
Okay. Suppliers are individuals, companies, sometimes government, and foreign investors. Got it. Now, flip side. Who's using all this capital?
The users are just as varied. Individuals are users, often for big purchases like a house or a car. That's usually through mortgages or loans.
Right.
Businesses, as we talked about, are major users for everything from just paying the bills day to day to upgrading equipment or big expansion projects. They often get this capital by issuing stock.
Selling ownership pieces.
Exactly. Or by issuing bonds, basically borrowing money from investors.
So when you read about a company issuing new stock, that's them tapping into this capital pool.
That's precisely it. Governments are big users too. They borrow a lot, issuing bonds to fund public services, healthcare, education, you name it, or big infrastructure projects like roads and bridges. And also sometimes just to cover budget deficits when spending is higher than revenue.
Okay.
And interestingly, you sometimes see foreign companies or governments wanting to use Canadian capital, maybe if our interest rates or exchange rates make it cheaper for them. Shows how interconnected it all is.
Yeah, it really does. So this constant flow, savings getting channeled to users who invest it. Now, the notes make a distinction between direct and indirect investment. What's the difference there?
Okay, so direct investment is when you put your capital straight into a tangible asset or a specific project. You have a direct stake.
Like
Buying a house. Your money is directly tied to that physical property. Or when a company builds a brand new factory, that's a direct investment in their own operations.
okay, clear link to the physical thing or project. So indirect must be different.
Indirect investment is when you put your capital into financial securities like stocks or bonds. You're not buying the factory yourself.
Right.
You're giving your capital to, say, the company that is building the factory or to the government. They then use your funds for their direct activities. This often happens with the help of an advisor or through a brokerage. So if you buy shares of Apple on the stock market, that's indirect. Or maybe contributing to an RESP for your kid's education. Your capital's working, but it's channeled through a financial instrument.
Got it. You're one step removed, entrusting the funds. Okay. Now, capital itself, it has characteristics. Mobility, sensitivity, scarcity. Let's unpack those. What's mobility about?
Mobility is, well, it's pretty amazing, actually. It's about how easily capital can move around across borders between different kinds of investment.
It's like water flowing.
Kind of. An investor today could sell shares they own in, say, a Canadian tech company and almost instantly use that money to buy bonds issued by a European government. It's incredibly fluid now, especially with technology.
Wow.
Think about a startup in one country suddenly getting funding from investors halfway across the world. That's mobility in action. It fueled global innovation.
Truly global finance. Okay, and what about sensitivity? Capital is sensitive to its environment.
Yeah, it's not blind. Capital tends to flow towards places and investments that seem safe, stable, and offer good potential returns.
Makes sense.
And conversely, it tends to shy away from situations that look risky or uncertain. Lots of things influence this. Political stability is huge. Economic health, like GDP growth, inflation tax policies, regulations.
So if a country suddenly looks unstable politically.
Exactly. International investors might get nervous and pull their capital out, looking for somewhere safer. Capital votes with its feet, so to speak.
Path of least resistance, highest reward. Got it. And finally, scarcity.
Scarcity just highlights the basic fact that there isn't an infinite amount of investment capital out there.
Right.
It's a limited resource, and lots of people, companies, and governments all around the world want it. They're competing for it. This competition means capital is always looking for the best opportunities, weighing risk versus reward. And it pushes borrowers to be efficient and offer attractive terms to get that capital.
A global competition for funds. That leads perfectly into country risk. How do investors actually evaluate where to put their money internationally? What do they look at?
It's a pretty thorough checkup, really. They assess a whole range of risks. The political situation is key. Stability, rule of law, are things predictable. Economic trends are vital. Is the economy growing? What's inflation doing? Unemployment. Fiscal policy matters. Taxes, government spending, monetary policy too, interest rates, exchange rates, how the central bank manages things.
Okay.
Then, of course, the actual investment opportunities available. Are there good companies or projects? What are the potential returns? And even things like the skill level and productivity of the workforce play a role in long-term potential.
So it's a real 360-degree view, politics, economics, finance, even the people.
Yeah.
Okay. Solid grounding on capital. Let's switch gears to the tools that help move it around. Financial instruments. What are these fundamentally?
Think of them as the contracts, the legal documents. They spell out the deal when capital moves from a supplier to a user.
Okay.
They define who owes what to whom, the rights, the obligations, all the terms of the agreement.
Like the fine print on a loan document or the certificate saying you own stock.
Exactly like that. And there's a whole bunch of different types, each designed for different things. Let's start with fixed income securities, sometimes called debt securities. What's the basic idea there? Simple terms, it's a loan. You, the investor, lend money to an issuer. Could be a government, could be a company.
All right.
The issuer promises to pay you back the original amount, the principal, at a set future date, that's the maturity date. And usually along the way, they make regular interest payments to you.
So you lend money, get interest, and get your original money back later.
That's the core concept. Common examples: Treasury bills, or T-bills, short-term government debt.
Right.
Or bonds, those are usually longer-term debt, from governments or corporations.
Right.
So imagine you buy a $1,000 bond from, let's say, company XYZ. It pays 5% interest per year. You typically get $50 in interest each year. And then company XYZ gives you back the $1,000 when the bond matures.
Okay. Straightforward IOU with interest. Got it. Now, what about equity securities? That's stocks and shares, right?
Correct. Equity means ownership. Stocks, shares, same thing. When you buy stock in a company, you own a tiny piece of that company.
A slice of the pie.
Exactly. If the company does well and becomes more valuable, your shares potentially become more valuable too. If you sell them later for more than you paid, that profit is a capital gain.
Okay.
Now, there are different types. Common stock or common shares is the basic ownership. Usually comes with voting rights. You get a say in some company matters. Then there are preferred shares. They often pay a fixed dividend, kind of like bond interest, and preferred shareholders usually get paid before common shareholders if the company goes bankrupt. But they often have limited or no voting rights.
So bonds are like being a lender, stocks are like being an owner. What's next? The notes mention derivatives. They always sound, well, complicated.
They can be a bit more complex, yeah, because their value isn't based on the thing itself. It's derived from something else. Yeah, derived from the price or performance of an underlying asset. That asset could be a stock, a bond, a currency, a commodity, even a market index.
Ah, okay.
Think of it like a contract whose value depends on how something else's price moves. They're often used for hedging risk or for speculation.
Examples.
Options are common. A call option gives you the right, but not the obligation, to buy an underlying asset at a set price before a certain date. You might buy one if you think the price of that asset will go up. Forwards are another type, basically an agreement to buy or sell something at a set price on a future date.
So not owning the thing directly, but a contract linked to its future price. Okay, clear now. What about managed products, like mutual funds?
Managed products or investment funds are basically pools of money. Lots of investors put their money together.
Okay.
And that combined pool is invested in a whole portfolio of different securities, stocks, bonds, whatever the fund's goal is. The key is it's managed by a professional fund manager or team.
So you pool your money and pay someone to invest it for you.
That's the idea.
Yeah.
Mutual funds are super common. They give you instant diversification because they hold lots of different things.
Right.
ETFs, or exchange-traded funds, are similar. They hold a basket of securities too, but they trade on stock exchanges like individual stocks, so you can buy and sell them throughout the day.
More flexibility.
Yeah.
Yeah.
And then there are things like private equity funds, which invest in companies that aren't listed on public stock exchanges.
So main benefits are diversification and professional management. Lastly, structured products. The name sounds custom-made.
They often are. Structured products are kind of financially engineered. They combine bits of debt, equity, maybe funds, to create specific risk and return characteristics. Tailored solutions.
Like?
Principal protected notes, PPNs, are an example. They aim to give you your initial investment back at maturity, plus potentially some extra return, based on how an underlying asset performs like a stock index.
Okay, protects your initial money.
Right. Or index-linked GICs. They guarantee your principal, like a regular GIC, but offer potential extra returns linked to a stock market index.
Yeah.
Again, custom-built for specific goals.
Okay, so we've got the capital and we've got the tools, the instruments to move it. Where does the actual buying and selling happen?
Financial markets, right?
Exactly. Financial markets are the venues, the forums. Not always physical places these days, much of it's electronic, but they're where buyers and sellers of these instruments meet to trade. Good markets need to be fast, cheap to trade in, liquid meaning easy to buy and sell without moving the price too much, and well-regulated for fairness.
Speed, low cost, easy trading, rules. Got it. Now, primary versus secondary markets. What's the key difference?
Primary market is for brand new securities. First time they're ever sold.
The first sale.
The very first sale. When a company does an IPO, an initial public offering, selling shares to the public for the first time, that's the primary market. The money raised goes directly to the company issuing the shares.
So the company gets the cash. Then what's the secondary market? Secondary market is for everything after that initial sale. It's where investors trade those already issued securities amongst themselves.
Okay.
So if you buy or sell shares of, say, Bell Canada on the TSX today. That's the secondary market.
Yeah.
Bell doesn't get any money from that trade. It's just investors swapping ownership.
Right. It provides liquidity, the ability to sell what you bought earlier.
Exactly. Crucial for investors.
Okay, primary is new issues. Secondary is trading existing ones. Clear. Now, auction markets versus dealer markets. How do they work differently?
Okay, auction markets. Like a stock exchange, think TSX. Buyers put in bids the highest price they'll pay. Sellers put in asks or offers the lowest price they'll accept.
Bids and asks.
Right. These orders go to a central place, could be a physical floor, but usually electronic now, and they get matched up. When a bid meets an ask, boom, a trade happens. Dealers in these markets usually act as agents, just executing orders for clients.
Like a real auction, but for stocks.
Pretty much. Key terms here: bid price, highest buy; ask price, lowest sell. The difference between them is the bid-ask spread, narrow spread, usually means it's easy to trade, liquid. Last price is just the most recent trade price, and liquidity itself is how easy it is to buy or sell without messing up the price.
Gotcha. Examples in Canada?
TSX Venture Exchange for smaller companies, Montreal Exchange for derivatives. Those are auction markets.
Okay. Central matching system. How do dealer markets or OTC markets compare?
Dealer markets are different. No central auction. It's a network of dealers, banks, market makers.
A network.
Yeah. These market makers hold inventories of certain securities. They post their own bid price, what they'll buy it for, and their own ask price, what they'll sell it for.
Okay.
So you trade directly with the dealer, buying from their inventory or selling to it. Here, the dealers act as principals, trading for their own account, taking on the risk. Prices are often negotiated.
Like buying a car from a dealership's lot.
That's a decent analogy,
Yeah.
A key thing is most bonds and debentures trade in dealer markets. The dollar value traded there is huge, actually much bigger than for stocks in dealer markets.
Really? Wow.
Yeah, they're sometimes called unlisted markets because the stuff traded isn't listed on an exchange. There is some trading of unlisted stocks, but it's usually smaller volume, maybe more speculative, less liquid.
So if I wanted an unlisted bond, my broker would call around to dealers.
Exactly. They'd shop around the network to get you the best price from a market maker.
Okay. Auction is central matching. Dealer is a network trading inventory. What about the money market? Sounds specific.
It is. Money market deals only with short-term stuff. Fixed income securities with less than a year to maturity.
Short-term loans, basically.
Yeah, think short-term borrowing and lending. Big companies might issue commercial paper here to manage cash flow. Investors buy T-bills here.
Yeah.
It's all about managing short-term funds.
Okay, short-term focus. And finally, electronic trading systems. These have changed everything, haven't they?
Fundamentally, they automate matching, execution, makes things incredibly fast, efficient, more accessible. Alternative trading systems, ATSs, are a big part of this.
ATSs?
Yeah, they're electronic marketplaces run privately that compete with the traditional exchanges. They offer another place to trade stocks and bonds.
Like another option besides the TSX.
Right. In Canada, equity ATSs have to be registered dealers, members of CIRO. They can trade stocks listed on the TSX, for example, but they can't list stocks themselves.
Okay. And for bonds, fixed income?
There are key electronic systems there, too. CanDeal is big for institutions, trading government bonds, money market stuff. CBID caters to retail and institutional clients for fixed income. MarketAxess handles corporate bonds, other fixed income. And CanPX provides real-time quotes for Canadian government bonds and T-bills, which helps everyone see the prices.
So it's all becoming very fast, very electronic, very interconnected. Wow. We've covered a huge amount of ground today.
We really have.
From investment capital, where it comes from, who uses it through all those different financial instruments,
The tools of the trade.
and finally into the markets themselves. Auction, dealer, electronic, it all links together.
It really does. And understanding these pieces, the capital flow, the instruments, the market structures, it's just, well, it's fundamental to understanding how the whole financial world actually works, how the economy ticks.
And hopefully this deep dive has given you, our listener, a much clearer picture of all that. Maybe next time you see headlines about interest rates changing or the stock market moving, you'll have a bit more insight into the why behind it, the actual mechanics we've talked about today.
Yeah, thinking about how those concepts connect to what's happening right now, that's the real takeaway. This look at Chapter 2 gives you that solid base.
Absolutely. It's a foundation for understanding so much more. We hope you found this deep dive valuable.
And hopefully you'll join us for the next one.
Definitely. Stay tuned for more exploration.